Hey, welcome back, options traders. Well, I got another good question from one of the traders in our group by email, and he was asking, should you sell puts to hedge your calls theta? And this is a really good question because, as I've talked about so many times before, everybody thinks that theta is a big risk. So they get fixated on theta. What can I do to reduce theta, or how can I hedge theta? And so they want to do it by selling an option. And they say, well, let me sell these out of the money puts. I can collect some premium and thereby reduce my calls theta and reduce my risk. But remember, with options, there are always trade-offs. So what are the trade-offs by selling puts to hedge your calls theta? Well, let's go find out more about this. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start off with the big fear that everybody has, and that is theta. Remember, this is one of our Greeks. It shows by how much your options price will fall for 1 day's passage of time. So if you buy a $100 call trading for $3, and let's say that you look at your broker's platform and it shows that theta is 0.10, what that means is that tomorrow's price should be $2.90. Now remember, very important caveat here. This assumes that all else is equal, mainly that the stock price will be unchanged, which of course is highly unlikely. So to see your option trading for $2.90 tomorrow is probably not going to be exact. It's probably going to be less than that or more than that. But if we were to put this into a pricing model and just take 1 day off of the time to expiration, yes, the call would be trading for $2.90. But we have to assume the stock price is equal, that volatility is equal, that nothing else has changed. So again, remember that this is the big fear that traders have. They say, oh, I'm watching my options price wither away. I've got to do something about it. But remember, we've talked about this in previous videos. Theta is a characteristic of an option. It's not a risk. Why? Well, risk is always defined as uncertainty, things that we don't know. But we do know with 100% certainty that time will pass in one direction at the same speed. In 30 days, we know that 30 days will have passed. So why is that a big risk? We know for sure all of the extrinsic value is going to zero, but that's just the value of the insurance policy. So the first thing to ask is, do you really wish to hedge this characteristic? All right, so with that, let's take a look at a long $100 call. Let's say the stock is 100, you've got the $100 call trading for 3. So it's an at-the-money option, so we know that the extrinsic value is 3. This option's price is made up entirely of extrinsic value or of time value, and therefore that $3 with 100% certainty is going to go away at expiration. And again, this sometimes is a little bit of an elusive concept. Let's say that your option is trading for $3 at expiration, and a new trader might say, hey, my option didn't decay at all. So options don't decay. Well, that's not true. You did lose this $3. What happened is that the stock rose to 103, and you just swapped out the intrinsic value for the extrinsic value. But make no mistake about it, the extrinsic value is going to go to zero at expiration. So here's what our risk graph would look like. So here's our $100 call. Remember that we get a bend right there at 100. Here's our maximum loss at 3. But today, our risk graph doesn't look like this in black. It looks like this in blue. This is called the current curve. And this current curve, over time, slowly marches down towards the black curve. Remember, the black curve only applies right on the expiration bell, on expiration Friday. So over time, let's say that the blue line moves from this position down to this one the next day. Well, that difference between the blue and the red lines is theta. For any given stock price, you can see it was worth a little bit more on the blue line compared to the red. Not by much, but that distance there is theta. The next day, maybe we move from the red line down here to the green. And every day, it just keeps slowly working its way towards this black line. And again, right on expiration Friday on the closing bell is when we hit the black line. So this is what theta looks like graphically, and again, this is what traders are fearful of. They just see it as withering away, and we need to do something to hedge it. So this is where traders will get the bright idea to say, you know what? Let me hedge theta. So remember, our stock is trading at 100. Our $100 call is 3. So therefore, our extrinsic value is 3. And we say, well, that's a lot to lose. It's 100% of the option's value right now. Let me sell an option, maybe the $95 put that's trading for 1. So this put is now $5 out of the money. I'm thinking, fat chance it's going to go down there. Let me grab this free buck. And therefore, I can now only lose $2 from the passage of time instead of 3. I have hedged this risk of theta. Okay, that might be okay to hedge theta. Did you hedge theta? Yes, you did. But remember, options have lots of moving parts. We have to say what else changed. So when you sell puts, yes, it is true that short puts will hedge theta. But they also increase the downside risk. Why? Short puts have positive delta, which simply means that they make money or like it when the stock price rises. Now, in the case of a short put, it also has negative gamma, so it doesn't really need the stock price to rise. We just can't have it fall. But it still has positive delta. You are going to be increasing those deltas as that stock price falls. So let's say that you sell the $95 put for $1. By itself, this is what the short $95 put looks like. So once again, we've got our bend right there at 95. Now I've changed my scale here. Instead of per contract, we're going to look at the total dollars. So yes, you did put $100 in your pocket, but look at this downside risk here. All right, you've got all of this unlimited downside risk, at least down to a stock price of 0. And look at how big some of these numbers are getting relative to the $100 you've got in your pocket. And this is one of the things that I find interesting when new traders just don't understand all of the moving parts. Because many times when they're doing, let's say, vertical spreads, they'll say, oh, I only paid $1, but I can make 4. I can only lose a little, but I can make a lot. I have a great risk-reward ratio. But then when they start hedging theta, they do exactly the opposite. They bring in $1 or $100, but they now have exposure, theoretically, of $9,500. That would be assuming the stock goes to 0 and you get assigned and have to buy it for 95. Yeah, that's unlikely, but not unlikely for it to go to 90 or 85, 80. Look at how big these losses can get. So if we combine our long call with this short put, what happens? Well, here is what we saw before. Here is the long call at expiration in black. Here's what it looks like today. Our theta is just this distance right here. So this is our current curve right here in red, but this is our long call. So I'm going to make this current curve now black. So by itself today, this is what our position looks like if we just held the call option. But if we buy the $100 call and then we sell the $95 put, we move from this black curve to this one. So look what happened. Look how much you've opened up this downside risk. That's because you now have positive deltas down here. See, on the long call, you were moving towards 0 deltas. That's your insurance policy coming to the rescue. That was the reason for paying the $3, the extrinsic value. But now when you've sold this put, you've now opened up that downside risk. Now, is there a benefit? Yeah, but look how small it is. It's that little tiny white sliver between the red and black lines. You can barely see it. That's the extra $1 that you put in your pocket. So before you sell that 95 put, you have to ask, is it worth getting this little tiny bump of shifting this black line up to the red line in exchange for opening up this downside risk? That's really the question, not, oh, yay, I'm hedging theta, let me sell these puts. So remember that these are the current curves, let's say with 30 days to expiration. But at expiration, we would look like this. This is our long call. Again, the $100 call. This would be the 100 call and the short 95 put. So you can see that once we hit 95, we start going into these positive deltas. We start accepting the downside risk that we used to be rejecting. Right there, that's why that black line is flat. So what's our benefit? It's this little sliver right here between the red and black lines. But again, the sole decision shouldn't rest on I'm hedging theta. The question is this: is it worth getting this little gap right here in green in exchange for accepting this, which remember keeps getting wider as that stock price falls? So the main thing to take from this is to always remember that options have many moving parts. And an analogy that I like to use is like it is with a car and, let's say, a helicopter. You might have a driving record of 10 or 20 years or more, perfect driving record, but that doesn't mean you should jump into a helicopter and think that you can have the same performance. Because if you drive a car, it goes forwards and backwards. It's one dimension. So just like stock can go up or down. It's one dimension. But when you get into a helicopter or into options, you have multiple dimensions. You see, a helicopter can also go forward and backwards just like a car, but it can also go up and down. It can go sideways. It can bank left to right. It can bank front to back, and it can rotate. So you've got a lot of different degrees of motion in a helicopter that simply are not available in a car. So again, just because you might have a perfect record driving a car doesn't mean you can just hop into a helicopter and get the same results. And yet that's how a lot of traders feel about options. Oh, I know how to trade stock. It goes up or it goes down. So if I'm bullish, I buy a call. If the stock goes up, the call price goes up. And if the stock goes down, the call price comes down. What else do you need to know? Calls are just cheaper substitutes of stock. And they don't realize that is not true. It's far from true. You have lots of moving parts. So the main thing to get from this, that unless you understand all of the things that will change when you are buying or selling options, be very careful about selling options to hedge theta. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.